Today we are diving deep into a crucial skill every aspiring forex day trader must master: technical analysis. It's not just about charts and numbers, it's about unlocking the stories and the patterns behind every market movement. Stay until the end of the video to transform how you view and engage with the forex market as we simplify technical analysis and reveal how it can be a game changer in your trading strategy. Technical analysis is the art and science of forecasting future price movements based on the examination of past market data. Primarily, it involves analyzing price charts and various statistical figures to identify patterns and trends. Unlike fundamental analysis, which looks at economic and financial factors, technical analysis focuses solely on price movement and market behavior. It's based on the idea that historical price actions can offer clues about the future market direction. The roots of technical analysis trace back to the early 17th century, evolving significantly over time with advancements in technology and computing. Today it is a vital tool in a trader's toolkit, harnessing the power of historical data to make educated predictions. By studying charts and patterns, traders attempt to identify consistent or predictable behavior. This analysis can range from simple charting techniques to complex algorithms used in automated trading systems. It's built on two fundamental principles: price movements follow trends, and that history trends repeat itself. These principles guide forex traders in interpreting chart patterns and making decisions based on statistical probabilities rather than mere speculation. So in order to start day trading and to start technical analysis, you need to understand a few simple things. The first thing is obviously that you need a trading platform to use and where you can do your charting, your technical analysis. So in this case, the most advanced trading platform is TradingView, so I really recommend for you to download it. And in order to understand technical analysis, first of all, you need to understand the trends of the market and how the market can move. So the first thing that you should know is that the market can move either upwards, so it is a bullish trend, and we can see that, for example, over here, the market usually moves with impulse and retracements, which we'll talk about later. But for now, you can see that basically the market moves from the left to your screen upwards to the right of your screen, and that is a very simple identification. That means that the market moves upwards. Then we can also have a downtrend. For example, over here we can see that the market moves downwards because it moves from the top to the bottom of the screen, and very simply we can obviously see that this is a downtrend. But that's not all. The market can move sideways as well. So if, for example, we go somewhere over here, we can find a side moving market. Over here we can see that the market is moving neither upwards, neither downwards, but rather moving sideways. So from the left to the right of the screen, the market doesn't move upwards, doesn't move downwards, it does move sideways. And this is a consolidation or a side moving market. So what you should know from this is that if we have an uptrend, the market's moving upwards, you as a beginner should always aim to buy. So you are never opening sell positions because that would be illogical. Imagine I would be opening a short position somewhere over here when the market's moving downwards. That doesn't make any sense because the market would just continue moving upwards and we would get stopped out. So you should always aim to open buy positions if it is moving upwards. If it is moving downwards, you should open short positions, and if it is moving sideways, you should avoid trading. So this is the first thing that you should understand about technical analysis. Very simple but very powerful thing is to avoid side moving market because you will most likely get stopped out. And there are some ways to trade it, but we'll not talk about it here in this video. And then we can move on to understand a few simple tools that you can use. So in order to better understand the movements of the price, you can use the trend line. If the market's moving downwards, you should connect the top points over here. So we have a touch here,
touch, 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 and so on. So if the market is moving downwards, you draw the trend line from top to bottom and you should connect these points. If there are more than 2 points, then it is a validation that the trend line works and that you should definitely take advantage of it. If the market is moving upwards, then the trend line looks differently. Now the trend line should help you and you should draw it from the bottom to the top. So now we can easily see that, for example, here the market moves upwards and we can use this to our advantage. For example, we can open buy position right here, we can open buy position right here, because we can see the market moves and then it comes back to the trend line where it is providing us with an opportunity to open buy positions. And same goes with selling. If we want to sell, the market is moving downwards. For example, currently we're at this point right here, so I would open a short position here. And the other thing that you should always use is support and resistance levels. Now, support and resistance levels is a fairly broad topic, but basically you can mark it. Basically, it's very simple to mark it. Here, if I move my mouse over here, if I draw the level, I can see that, for example, the price is respecting the level. So here it is being retraced, and basically this level pushes the price upwards. So it was moving downwards and it stopped to this level and it moved upwards. So that means we have a very strong level over here. Then we have another level right here, and basically we can see that these levels work all over the price. If I draw the level right here, we can see that it worked perfectly over here. It was used as a support, then as a resistance, then when it was broken, the price came back and again it was being respected by the price. So support and resistance levels are crucial, and it is very easy to understand them, very easy to draw, and you will get better and better with time. And for example, right here, based on support and resistance levels, I opened the position. Another tool that you can use is Fibonacci retracement. Again, Fibonacci requires a little bit longer explanation, but basically because it is a downward moving market, we can draw the Fibonacci from the top to bottom, and we can see that over here we have a Fibonacci level which perfectly aligns with the trend line and with support and resistance level. So that means that over here we can open our short position, we can move the stop loss over here, we can make it wider, then we can play the price and see what happens, and boom, the price moved right into our take profit, and it was a simple trade with some simple tools. Another powerful tools that you can use are indicators. So again, there are thousands of indicators and each requires another episode to explain, so we'll not go over them, but basically there are different indicators. For example, Bollinger Bands shows you the range of the price when the market is at the bottom, when the market is at the top, and these ranges acts as a support and resistance levels. And for example, when the price is at the top, then you should open sell positions, and when the price is at the bottom, you should open buy positions. So indicators are definitely worth exploring. It is a great tool to have in your arsenal. We have exponential moving averages, we have RSI, we have MACD, and tons of other useful indicators that you can use. So you should understand indicators, you should understand trend lines, support and resistance levels, and use these to your advantage, to your technical analysis. Also, always look out for the market structure. That means whether the market is moving upwards, whether it is moving downwards, whether you should open buy or sell positions, whether you should use trend lines and support and resistance levels.
While fundamental analysis provides a broader view of market conditions, technical analysis offers precise entry and exit points based on price movements. It's crucial to understand that technical analysis is a tool and not a crystal ball. It should be used in conjunction with other analysis methods and market knowledge for balanced approach. So that's it for today's episode. If you found it useful, leave that like button, subscribe, and see you in the other videos.